Dividend investing has easily been one of the most popular investing strategies over recent history, and for some very good reasons. So basically, some profitable companies will choose to pay out their earnings directly to their shareholders in the form of dividends, which are on a cash basis every 3 months typically. So instead of having to wait for a stock's share price to rise over time, you can just sit back and be consistently rewarded through dividend payments flowing into your brokerage account. In fact, ever since 1926, dividends have contributed nearly 1/3 of total equity returns for US stocks, while capital gains have contributed 2/3. So clearly they are a significant source of returns for investors. Now there are several benefits to dividend investing, which include the ability to generate monthly passive income that can actually grow over time, preferential dividend tax benefits as opposed to your ordinary income, and finally downside protection during recessions, as safe dividend companies are able to continuously pay out their dividends, which ends up protecting their share price. Overall, there are a multitude of benefits when it comes to dividend investing, and I myself am actually a very big fan of certain dividend companies, but there are also some big risks when it comes to dividend investing that you must be aware of before even considering your first dividend stock. So in this video, I'll be highlighting the 3 biggest dangers of dividend investing that many investors are simply unaware of and how to avoid them altogether. So if you do enjoy, make sure to drop a like on this video to help support the channel, and if you haven't already, definitely consider subscribing for more future investing content just like this. Anyways, with that said, let's get right into the dangers of dividend investing. Alright, so before investing in any dividend stock, it's very important to assess the free cash flow of the business in question. Oftentimes, the first metric that investors will check is the dividend payout ratio to be able to assess the health of the dividend or how safe the dividend might be in the future. The payout ratio is calculated by dividing the annual dividend per share by the annual earnings per share, which gives us a percentage of the company's earnings. And typically, it's good to see this number below 60% for most companies, otherwise you can run the risk of the company cutting their dividend during periods where earnings decrease, like in a recession. But it's also equally as important to assess a company's free cash flow, which is just the cash left over at the end of the day and is used to pay dividends. For example, let's take a look at Fortis, which is a major utility company up here in Canada. We can see here that Fortis pays an annual dividend of $2.02 per share, while they earn $2.60 per share in 2020, giving them a reasonable dividend payout ratio of about 75%. However, when we look into their statement of cash flows, we actually find that Fortis has free cash flow of negative $1.3 billion for 2020. This means that based on the company's annual earnings alone, Fortis is unable to pay that dividend without additional cash from raising equity by issuing shares or by taking on additional debt. And as we can see here, in 2020, Fortis aggressively raised $6.6 billion of debt and issued $58 million of common stock to be able to fund the dividend and their capital expenditures. Now, to be clear, this isn't necessarily a big issue for Fortis, and based on the stock price being near its all-time high, investors seem to be completely fine with it. In fact, Fortis is planning on raising their dividend 6% per year over the next few years, according to their investor fact sheet. So what is the problem here? Well, since the company is having to continually take on more and more debt, this effectively increases the risk of the investment. And here we can see that Fortis's long-term debt went from $20.8 billion in 2017 to $23.1 billion in 2020 and doesn't seem to be slowing down anytime soon. And if for some reason the company couldn't increase their earnings fast enough to cover their growing interest payments of about $1 billion per year, this might require the management to cut that dividend or raise additional capital by diluting shareholders. So clearly, even though we might see a reasonable payout ratio of about 75%, this does not paint the entire picture, and it doesn't necessarily mean that the dividend is sustainable over the long term if the company can't generate free cash flow. Now, I'm not trying to bag on Fortis in any way because this is a stock that's in my portfolio, but it just goes to show that even though companies can have decent payout ratios, it doesn't mean that they're sustaining that dividend based on their earnings alone. And now that brings me to my next point about the dangers of dividend investing, and this involves interest rates. So lately, there's been a lot of talk about rising bond yields, increasing the risk of rising interest rates over the next few years, and this can have an unfortunate impact on dividend stocks in particular. In fact, there are 2 different types of interest rate impacts that we need to talk about. The first is financial impacts, and the second is competition impacts. Financial impacts just means that rising interest rates are going to have a negative impact on company financials, specifically those with a lot of debt, such as utility companies and oil and gas companies, etc. So as interest rates rise, the profitability of businesses decreases proportionately because these companies are required to pay higher interest payments on their loans. And as a result, dividend companies loaded with debt will have a lot less cash available at the end of the day to pay their shareholders in dividends. For instance, if we take a look at Fortis here again, we can see that their long-term debt was at $23.1 billion at the end of 2020. Now, just as an example, let's say that Fortis's average interest rate that they pay on their loans rises by 2% over the next 5 years as the Fed raises interest rates. Well, this would mean Fortis would owe an additional $460 million of interest each year. So based on their annual interest expense of about $1 billion in 2020, this would increase by nearly half to $1.5 billion if rates were to only increase by 2%. And in Fortis's case, you can be certain that this would have a negative impact on the company's payout ratio, meaning it would reduce their ability to meet the dividend payment or increase it further in future years. Now, the second impact of rising interest rates we need to talk about is the competition impacts, and this is equally as harmful to investors. In the market, there's always competition between stocks and bonds for the best risk-adjusted returns. And when bond yields rise with interest rates, this means that the risk-free rate basically gets higher, and so it reduces the attractiveness of dividend stocks in particular. For example, we can see here that the 10-year Treasury yield is sitting at 1.7%, which is considered the closest to risk-free that you're going to get. On the other hand, we can see that Fortis's dividend yield is sitting at about 3.7%, but you're taking more risk investing in Fortis because the company's share price could fall. So as interest rates rise, this means that investors will be less willing to take the extra risk to invest in higher yielding dividend stocks, and this will eventually have an impact on the share prices going down. For these reasons, Warren Buffett says that interest rates act like gravity on stocks because even small changes can have a huge impact on company share prices. Now, on the other hand, if we look at bank stocks, for example, which you all know I'm a huge fan of, these companies will actually benefit substantially from rising interest rates. And as of now, their dividend yields are incredibly attractive too, with relatively low payout ratios. Overall, though, I think it's really important to diversify when it comes to dividend stocks and to also understand the impacts of rising interest rates on a given dividend stock sector. All right, finally, we need to talk about disruptive innovation and how this can have a detrimental impact on certain dividend stocks moving forward. Lately, there's been a lot of talk about certain industries that are going to be rapidly evolving over the next decade, such as the automotive industry moving to electric vehicles, along with the oil and gas industry facing challenges. So these are both examples of disruptive innovation, but how does this relate to dividend stocks? Well, let's take a look at good old Warren Buffett's company, Berkshire Hathaway, as an example. This article here says that one of the main reasons why Berkshire hasn't paid a dividend is so that their wholly owned subsidiaries can invest as much as they can or want back into their businesses without capital constraints. For example, Berkshire Hathaway Energy, which is one of their subsidiaries, has grown to be the industry leader, often having superior service and lower prices than its competitors. And the article says because of Berkshire's investments in wind energy, Berkshire's Iowa utility beats its main competitors' electricity rates by a stunning 70%. Buffett then goes on to say that he's better positioned than anybody in the energy business just because we don't have dividend requirements. So this just emphasizes how dividends can actually be destructive to a company if they don't have enough cash flow left at the end of the day to reinvest back into their businesses to avoid disruptive innovation. Now keep in mind, guys, this is just one example. We can also see that Amazon has been taking market share from the traditional retailers that may have had very attractive dividend yields but failed to innovate. And I actually see several industries that are going to be facing this exact dilemma over the coming years. For instance, the auto industry. And if we take a look at Ford and GM, they typically pay really good dividends, but they won't have enough cash flow to invest heavily enough into electric vehicles. We can even look at ExxonMobil, which is easily one of the best dividend-paying companies in the world, with a history of annual dividend increases going back 38 years, and the company currently has a dividend yield of over 6%. But because this industry is going to be facing major headwinds as the world adopts electric vehicles and more climate-friendly alternatives to oil, Exxon will have to invest heavily in new technologies through research and development costs as well as CapEx. And I can almost guarantee that this will put pressure on the dividend long term, so I'm tending to avoid these types of dividend stocks. Those that are facing disruptive innovation while failing to reinvest their profits. So overall, I think it's incredibly important to be selecting dividend companies in industries that are not going to be going away anytime soon, and that will not be burdened by paying a dividend. Anyways, that's gonna wrap up this video. If you guys did enjoy, make sure to drop a like on this video to help support it. And if you haven't already, definitely consider subscribing for more content. And let me know what you guys think about these dangers of dividend investing down below, because I would be curious to know. I personally had not even thought about the disruptive innovation point, so that's definitely something I'm going to be looking for moving forward when I select my dividend stocks. But anyways, with that said, I will see you guys in the next one.